to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures pointing to a mixed open on Wall Street. Investors on edge around the future of the Federal Reserve and monetary policy. Markets recovering from the whipsaw action after President Trump denied reports that he would be firing Fed Chair Jerome Powell soon. This coming as the future path of rate cuts is at top of mind despite President Trump's calls to lower rates. New York Fed President John Williams said last night maintaining current policy is, quote, entirely appropriate. And the parade of Fed speak continues today with Fed Governor Adriana Kugler set to speak at 10 a.m. Eastern. Plus, earnings driving the action on Wall Street, too, of course. Some of the key names we're watching. Taiwan Semiconductor rising on better than expected results. Its second quarter profits soared over 60% from a year ago. Plus, PepsiCo getting a boost ahead of the open. And retail sales coming in much stronger than expected, rising 0.6%. This is the latest sign of a resilient consumer. President Trump's tariffs do not appear to be putting a damper on spending yet. Let's get a check-in on stock futures. Given all of that, we have now seen all three major averages indicating a green open, switching into the green here. The Dow right now, very little change, but slightly to the upside. The S&P 500 pointing to a gain of about 0.5% at the open, and the NASDAQ pointing to a rise of about 0.33%. Let's turn now to our top stories of the day. The Fed in focus as President Trump says he has no plans to fire Powell. Meanwhile, we'll hear from more Fed officials today after New York Fed President John Williams says he's reluctant to cut rates as tariffs drive inflation higher, plus earnings season gaining steam with strong results from Taiwan Semiconductor and GE Aerospace, and retail sales data giving a fresh read on the state of the consumer. Joining us now, Fed correspondent Jennifer Schonberger, senior reporter Ali Canal live from the NASDAQ, and markets reporter Josh Schafer. Jennifer, let's start with you. And yes, the president did deny it yesterday, but it wasn't, he was like, well, maybe he'll still have to leave. So it wasn't entirely his job is safe, for the remainder of his term kind of a denial.
Yeah, it's certainly been a wild ride this week, hasn't it, Julie? The president seeming to suggest earlier in the week on Tuesday that he has cause to fire Fed Chair Powell based on statements that Chair Powell made to the Senate Banking Committee on renovations about the Fed's headquarters here in Washington, D.C. I'm no lawyer, but the statute, the law clearly does state that the Fed has power over its headquarters and what it needs to do to keep its headquarters up to date. That said, there were reports yesterday, Wednesday, that the president was drafting a letter to fire the Fed chair, only to turn around, as you said, and tell reporters that he has no intention of firing Fed Chair Jay Powell, but sort of left the door open. We saw a reaction in the bond market. The 10-year seemed to pop up. Stocks certainly reacted. And he said that he had talked to congressional Republicans behind closed doors who said they were on board with the notion of firing Powell, but that he wasn't going to do it. So clearly the president pulling back from the brink again. This is the second go around we've really seen of this so far this year, and it likely won't be the last. But I think it's important to note that even if you were to get rid of the Fed chair, it's really the interest rate setting committee, the whole Federal Open Market Committee that sets interest rates. So it's a holistic decision. It's not the Fed chair himself. And last night we heard from the vice chair of the FOMC, New York Fed President John Williams, who says that he is very content to hold rates steady for, it seems, the foreseeable future. He says we are starting to see the impact of tariffs on inflation, and he is forecasting that we could see a full percentage increase in inflation in the second half of this year into early next year. He's looking at inflation popping up to about 3 to 3.5% for 2025. And he also added that the weaker dollar could be inflationary as well.
And then, Jen, we mentioned that we are going to hear from Adriana Kugler today as well. Where does she tend to stand on the Fed spectrum?
Yeah, she seems to be more at the hawkish end of the spectrum. She is supposed to give a speech on housing. We'll see if she mentions anything about housing inflation, which has been somewhat benign, right? It's the goods part of the the inflation side that we've seen starting to tick up, not the services as much. So we'll see if she says anything on monetary policy. But she has said that so long as there is risk for an upside to inflation, she is content to hold rates steady. We know there is a group of Fed officials within the FOMC who are not in favor of cutting rates at all this year. It sounds like she may be in that camp. Can't know for sure, but she is clearly on record saying that she's more concerned about the inflation side of the mandate rather than the employment side.
Well, and let's talk about some economic data that came out this morning that could inform the Fed as well, although it doesn't tend to be sort of core to the numbers they look at. But that's retail sales. And Josh, there we saw people are still spending, it looks like, through the prism of that number.
Yeah, Julie. So we saw a rebound in retail sales in June. So you mentioned earlier sales increasing 0.6% in June. That was both the headline number and the number that's excluding auto and gas. The control group, which sort of feeds into GDP, that increased 0.5% in June. So really a relatively solid print here just in terms of the health of the U.S. economy. Capital Economics North America economist Thomas Ryan just writing in a note to clients that this release just dispels any fears that overall consumer spending is faltering in response to tariffs. That's really what we're looking for within this release. And the other positive sign in economic data that we got this morning too, Julie, initial jobless claims continue to move lower. Remember, going back to May, we had been talking about initial claims continuing to tick higher each week. That's the number of Americans that are filing for new unemployment benefits every week. That came in at 221,000. That's the lowest level we've seen on that metric in 3 months. So not seeing real clear signs of layoffs here. We know hiring is still ticking lower in the labor market, but you're not seeing layoffs pick up, which again, as we sort of talk about that Fed rate cut conversation, if claims were moving significantly higher, that would maybe boost the case for a cut, but the data not really boosting any sort of case for a cut this morning.
Yeah, and one important caveat when you're looking at retail sales, they are not inflation adjusted. So they would account for if prices rose, and that's part of the increase in spending, that's how that would show up sort of in that number. Ali, Josh was just talking about what this does to Fed rate cut odds, which I know is something that you've been watching closely.
Yeah, if we take a look at the CME's Fed Watch tool, this is what markets are pricing in when it comes to that next Fed rate cut. And consistently, we had seen markets looking at that September Fed meeting as the next time the Fed will slash interest rates. That had been hovering around a 70% chance. Now I'm looking at 50%. So we're at a 50-50 odds now that the Fed cuts in September. And we've seen a variety of Wall Street firms really adjust their targets here. Morgan Stanley is not projecting any rate cuts this year. They're looking ahead to 2026. Capital Economics believes we're going to see our first cut in December. So you just have a variety of opinions on Wall Street. We do have that Fed meeting coming up at the end of this month. Pretty much 100% odds that the Fed remains on hold. And I think this data certainly supports that narrative here. So that's going to be another thing for markets to keep an eye on as we continue to wade through earnings. And so far, we seem to have a pretty strong start there. What happens on the Fed side? We know President Trump has been very outspoken in his want to have those Fed funds rates lower, but he might have to wait a bit longer there. And I'm curious how markets are going to react if we see those rate cut odds get pushed out a little bit, and also how that feeds through to the 10-year Treasury yield as well. We're seeing that hover around 4.5%. We know when we hit that 4.6% level, that starts to weigh on U.S. equities.
Let's talk about earnings too, guys, because obviously we're in the thick of earnings season now. Ali, as you point out, as you have pointed out to us, it's a mixed bag, right? But let's talk a little about which are the sort of highlights that you're watching. I know TSMC is on the list.
Yeah, TSMC a big standout here. And when we talk about the mixed bag, you take a look at something like Pepsi, which really had a better than feared report. We're seeing shares up this morning, but even heading into this earnings season, the stock was down around 11%. So some of these consumer names have been a little bit more beaten down. But when you look at a name like TSMC, just delivering these solid results, 61% profit surge, soaring AI demand, there's a clear read through here when it comes to what's working best and most consistently in this this market, and that's AI. That's really the nucleus of this rally, and it extends beyond the tech sector as well. Of course, for TSMC, there are still headwinds when it comes to Taiwan. Those reciprocal tariffs, a lot of uncertainty. That was something that the CEO talked about in the release. But we've also got some clarity on that part too. NVIDIA, for example, which is one of TSMC's biggest customers, they will be able to sell those H20 chips to China. They had that sign off from President Trump. This was something that TSMC talked about in the earnings call, saying that this is good news for their customer and therefore it is good news for them. So just a lot of catalysts here heading into the thick of earnings season, and this sets us up well for some of those hyperscalers and of course the biggie NVIDIA, which is set to report next month.
Yes, and we've got Netflix after the close today. You're going to be busy doing that. We'll talk about that a little bit later in the morning. Thank you so much, Jennifer, Ali, Josh, appreciate it. Well, we also heard Ali mentioned PepsiCo and those numbers here. We want to go to our Brian Sozzi, who has been drilling down into those Pepsi numbers. So, Soz, what stands out to you? What have you been hearing from the company?
Drilling down, Julie. I'm just drinking up this earnings release from PepsiCo. I'm here all day. I'm taking tips. But a couple things that stood out to me here. Ali mentioned at the top that shares are getting a positive reaction. Just 3 months ago, we heard from PepsiCo. They cut their guidance. Very rare move by the company. I caught up with Ramon Laguarta, chairman and CEO of PepsiCo, by phone this morning, telling me consumers are still, quote, challenged, but they just executed better in this quarter, getting out more affordable prices, more affordable packages, more smaller packages there, targeting consumers, watching every dollar that they spend. I also asked him, too, because compared to 3 months ago, we have seen a wave of deal activity inside of packaged foods, notably breakups. Of course, looking at you, Kellogg, breaking up in two and different deals on the table for those two separate companies. I don't think PepsiCo is inclined to even consider a breakup. They have been pressured in the past to think about this. That pressure may be increasing now, given the deal activity we've seen in the space. I don't think they're looking to do it. That said, I do suspect they are nearing some new cost savings plan looking forward, so I'd be on the lookout for that. And then, of course, Julie, I had to ask him about President Trump coming out yesterday and noting that Coca-Cola was going to start using real sugar instead of high fructose corn syrup. PepsiCo making this note, or Ramon telling me this, that 60% of PepsiCo's products are either zero sugar or they already use cane sugar, open to moving to all sugar instead of high fructose corn syrup if the consumer wants that from them, Ramon telling me.
Or maybe if the president or the health secretary
and
I will say, maybe that stat, I'm sure is accurate. Pepsi itself, though, does, just like the Coca-Cola flagship product, both of them do have high fructose corn syrup right now.
Yeah, it's just a matter of two, Julie. Where are you getting all of this supply from in the U.S.? And now also keep in mind, Coca-Cola has not actually confirmed what Trump said, so we're watching out for that one as well. Well, this is a very important moment for packaged food industry. Not only are they being pushed to change ingredients, but also reconsider the very business models they've spent decades building.
Yes, business models, supply chains, et cetera, could have a big ripple effect. Brian, thank you so much. Appreciate it. Coming up, we count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's top trending tickers. We're watching GE Aerospace, Abbott, and Elevance. First up, shares of GE Aerospace hitting a 25-year high in pre-market after a blowout second quarter report. The jet engine maker beat expectations on multiple fronts, raising its full-year outlook for profit and revenue growth thanks to a robust commercial services outlook. The company has benefited from a surge in orders. CEO Larry Culp has been vocal in his opposition to President Trump's tariffs and has spoken with the president directly about the potential impact. The company plans to offset tariffs through cost controls and price increases. And remember, that high that we're seeing in the stock is after it separated its healthcare units into GE Healthcare, and then there's GE Vernova, which has the gas turbine business. Next up, Abbott narrowing its full-year outlook despite reporting largely in-line results for its second quarter. Demand for medical devices drove growth during the three-month period. Strength in U.S. sales offset by declines overseas. President Trump has said that tariffs on the pharma industry could come by August 1st. In April, Abbott announced plans to make new investments in U.S. manufacturing in anticipation of those potential tariffs on the industry. And finally, Elevance's second quarter results fell short of expectations, prompting the health insurer to lower its annual profit forecast. Elevance, the latest insurer hurt by tougher regulations and rising costs. Rivals like United Health, Centene, Molina, they've all previously cut their forecasts due to increasing costs tied to government-backed plans, including Medicare Advantage, Medicaid, and Affordable Care Act plans. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, President Trump told reporters Wednesday that 150 nations would receive tariff letters with offers likely between 10 and 15%. That's ahead of that August 1st deadline for updated trade deals. Markets seem to be shrugging off the latest trade back and forth. My next guest says volatility potholes, as she's calling them, could be ahead in August. Joining me now, Amy Wu Silverman, RBC Capital Markets equity derivatives strategist. Same today. We had the same thought on the color there, Amy. Good to see you.
Good to see you.
You know, this has been sort of an ongoing discussion we've been having with you and other strategists, just how resilient the market has been, at least on the surface, in the face of these continued tariff threats. Is there anything under the waterline, so to speak, that you're seeing?
Look, there is, Julie. I think there is a lot of angst under the surface. One way that we identify that is just, how do option prices, how does volatility look in the future? So maybe not the next month, maybe not the next 2 months, but even 3, 4, 6, 12 months out. And that's where you do start to see investors demanding protection. There's heightened levels of volatility. We refer to that as the term structure, but it's simply saying that there is a good deal of worry, not necessarily for the summer months as the negotiations are still going on, but longer term, there could be any number of reasons why, but it is much higher than normal. And that actually has been true since Liberation Day.
And so do you think that there is complacency in the markets right now? And if so, I guess define what complacency is and what the risks are around that.
Yeah, so when you think about it, if you were an investor who was worried about tariffs and you had obviously that gap during Liberation Day, but then you really got whipsawed, right? So when the market rallied that hard, you actually were caught off sides, and then you've had difficulty hedging near term because a lot of what Trump says, is subject to negotiation, is subject to deadlines being pushed back. Essentially what's happened is those folks who have been hedging kind of post that rally began have had a hard time. And so it's hard to keep those positions on. That's not necessarily complacency. It's just this turbulence with regard to timing. I would flag that we're going into August, which tends to be seasonally poor for returns, seasonally high for volatility. And August 5th last year is when we got a major volatility pothole with the VIX spiking to over 60.
Right. The summer has this sort of false reputation of being quiet when it's not necessarily a lot of the time, Amy. The other thing that has been causing a little bit of volatility in the market, certainly we saw this play out yesterday, is this sort of back and forth around the future of the Fed. And whatever happens at the top of the Fed, the sort of continuing independence of the Fed. What felt like sort of a trial balloon on the part of the administration yesterday did see a reaction in the markets that maybe sent a message to the president.
Yeah, it absolutely did. And I think what's been interesting, like part of the reason I think you're getting, you can call it complacency or just maybe sanguineness in the market, is essentially the fact that the Trump administration is willing to send out these trial balloons, but at the same time, when you start to see panic in the bond market perhaps, or in VIX, that's quickly withdrawn. I still remember back to this interview with Scott Bessent post-Liberation Day, where he actually said, look, I think the VIX is spiked. I can't remember another time where you've had the Treasury Secretary commenting on the level of the VIX, but the fact that he said that, it just tells me they're very aware of the market. Perhaps that means there are some guardrails. We can guess what strike those guardrails are at, but you are there sort of to some degree negotiating against those reactions too, and that is important to keep in mind.
Do you think in some ways that the tactics of this administration has been to, we sort of saw this play out with tariffs, right? The big reaction, the negative reaction, and then the pullback on the part of the administration. But then since then, the sort of like steady chinking away at that wall, perhaps, chipping away, right? Trying to get through. Do you see that applied in other ways, like what's going on with the Fed, for example?
Yeah, when you think about the strategy of it, the kind of like the initial headline poster board we got with all those high tariff numbers, there's some human psychology involved in the sense that anything we walk down from then obviously seems better, even if that was the outset of what we had started out with. The reaction, certainly would have been worse. So it's like that play on human overreaction and underreaction. We can really see that quantified, Julie, because we see it in the factor rotations that have occurred since Liberation Day. So the best performing factor has been momentum. And you've seen this big trade-off, multi-standard deviation trade-offs in momentum factor against something like value. To me, again, that goes back to this big overreaction you got from tariffs, and then anything we get that was lower than that initial poster board number, the market is actually tending to underprice that.
And so now, of course, we're going into earnings season. That's the next big catalyst. It feels like, given the discussions we've been having, that investors are feeling pretty good going into this period. So does that imply that, at least for now, barring another volatility pothole or shock, that the path of least resistance is higher?
I think for the short term, yes. And that is how you're seeing it priced in the options, meaning, you don't see VIX spiking in the near term. You don't see this heightened demand for skews, so that demand for downside protection. What I will tell you is, because the bulk of my day is spent talking to institutional investors, they still remain pretty angsty. It's just a function of, they also know they can't miss out on any rallies because that's hurt them a lot post Liberation Day. But I wouldn't tell you that the sentiment is actually necessarily all that positive. They're just very hesitant to hedge when they know there's this possibility that a lot of things get can-kicked. I think that's why you continue to see the options market tell you there is worry. It's just further down the line.
Really interesting perspective and helpful. Amy, thank you so much.
Thank you.
Well, coming up on Yahoo Finance Opening Bid, our own executive editor, Brian Sozzi, is with us now. What's coming up on the show, Brian?
We're going to dig further into all things PepsiCo earnings. Julie, company beat on sales, beat on earnings. Also, I would say came out with a somewhat optimistic outlook after disappointing everyone 3 months ago. Also, big interview of the morning, Julie, here on Opening Bid. Carlyle Group co-founder David Rubenstein weighing in on all things Fed independence and a little bit of the Baltimore Orioles, which he happens to own.
You know that I love to talk about my O's there, Soz. Are you a Pepsi or a Coke guy?
I'm not. I will not answer that because I have contacts on both sides of the equation. So I will take a page out of my PR friend's many books, and I will decline to comment.
Fair enough. All right. Thanks so much, Soz. That does it for Morning Brief. Much more ahead on Yahoo Finance. Soz got you for the next 30.